today I'm really excited that we have the co-CEO, former co-CEO of Whole Foods, and he is going to be in conversation with our own Professor Jeffrey Pfeffer. Jeff is a star teacher, as many of you know. If you haven't had the chance to take his class, I hope you do, class on power. He's done award-winning research on that topic. He has a number of popular books, the most recent of which is Dying for a Paycheck, where he explores the health implications of our current management and employment norms. And I'm very happy to have Jeff here to interview and have a conversation with Walter.
It really is a pleasure, Walter, to welcome you. And I want to start off by talking about the unique culture and practices of Whole Foods. It is obviously difficult to do what I just described, the people-centered promotion from within, strong culture organization. And it's difficult to do this because if it were easy, more organizations would have done this. So talk to me briefly about how you were all able to maintain, not only initially, but over a long period of time, this unique and strong organizational culture.
Good morning, everybody, and it's great to be with you. Thanks for the invite, and I'm really looking forward to visiting with you, with the students later in the session as well. Look, I think the heart of it is that Whole Foods is at the very core a mission-driven organization. The highest order of questioning about any company is, what is your purpose? What is the reason for being in business? And in the case of Whole Foods, it was very much around bringing healthier food options to the world and also creating a company based on love and respect. So around that that purpose and around the core values that we develop, core values being those things which you believe, not mutable, but fundamentally for beliefs that you hold about how to conduct yourself. You take the purpose, you take the values, and from that comes a culture, which I define as how customers feel shopping with you and how team members feel working for you. It's a living petri dish in which the company unfolds. And so, but without the North Star of a clear purpose, without the anchor of values, which grinds you in the thinking about a wider stakeholder community, the culture would not have reached the depth that it did and the strength that it did in Whole Foods. And so you ask, how did we sustain it over years? We I think did have the North Star that guided us in where we were trying to go in that deeper purpose that brought all the team members together and the customers could feel that. And second of all, one of our core values was team member happiness and excellence. And we really tried to, we saw the team member stakeholder as more important than the shareholder stakeholder, and tried to elevate that through a series of cultural practices that we continued to build on and invest in over the years. So look, there's no one short answer to your question, but I will tell you that unless you as an organization continue to make decisions in alignment with the purpose and the values and the culture you say you have, folks will lose faith in it very quickly. On the other hand, if you continue to make decisions and take actions that let people continue to believe that we're really doing something meaningful, you can build a very powerful culture.
So let me continue on that culture theme. One of the things that Whole Foods did that many people I don't think necessarily remember is that Whole Foods grew a lot through acquisition. And oftentimes when you acquire other organizations, the issue of integration becomes very difficult, particularly as you have a very strong culture and they may have a different culture. What did you all do to make sure that you're when you bought a chain of other natural food stores, that they became Whole Foods like and didn't become, you often see, I'm sure you've seen in your own experience, and I've seen in my experience, you buy companies and they never really become part of the organization. So I think it's a very important issue to talk about how did you go about integrating the acquisitions?
It's a great point. Well, I respect, I bought 19 companies as co-CEO with John, and so I have a lot of experience in this. But first one is, it's the way you think about it. We chose to use the word merger rather than acquisition. I don't think anybody wants to be acquired. I think they want to be respected. And so we would talk about merger, we would talk about the strengths that they bought. And there's a lot in it in your planning of when you're doing the merger, the way you announce it, the way you talk to team members. We would always meet, particularly in the early days, with every team member of the company of which we were joining. And we would give them, said, hey, recognize you don't know how this is going to work out to you. There's usually the camp one that knew they didn't want to do it, camp two that needed more information, and camp three was pumped to get on with it. So we would provide that sort of time. And the regional presidents at that time, you know, Will Paradise, I'm thinking when we bought Wild Oats in 2007, he met with every single Wild Oats team member. Now that may have been over the top, but that was the level of thought and care, I think, around it. Ultimately, mergers are about people and people joining, and the care with which you practice mergers should be the same that you're practicing with your team members every day. So we thought about it with that language. We thought about it with that approach. We thought about trying to highlight the things that they could feel good about they'd accomplished prior to joining Whole Foods. We obviously had to think about the synergies of putting the two companies together. Sometimes difficult choices had to be made, but we never forced a name change. So what we typically did was take, let's say, Bread and Circus. We went Whole Foods. We went Bread and Circus, Whole Foods Market. So we maybe went a year and a half or 2 years before we changed the name to Whole Foods. So there was a level of respect in doing those things that I think, you know, we built at the end. When we sold to Amazon, we were about 110,000 team members in 44 states and 3 countries. And I think with a very strong culture. And by the way, remember that when you build a dynamic company, there's just so much value to merging with other companies. It's like, imagine a river running to the stream, the way I described Whole Foods. And along the way, other rivers joined in, tributaries joined in, making the river stronger. So as we reached for the sea, which the definition of the sea for us was Whole Foods becoming mainstream, and the acceptance of the quality of food was the mainstream objective. The richness and the dynamism that comes from joining with another company is powerful. And so thinking you can do it all yourself, your company becomes much stronger through merging with other companies and bringing those talents and those people to bear.
So one of the things that I think stands out about Whole Foods, and you just mentioned it, is this issue of, you know, valuing the teammates and having this declaration of interdependence, and the idea of having stakeholders that you took very seriously, caring for the suppliers, caring for the teammates. I think you just said putting teammates even ahead of the shareholders. That is something that doesn't necessarily play well, particularly as a public company. How did you all manage the pressures? Because Whole Foods was a very distinct organization and different from, Lord knows, many of the grocery stores, which were not nearly as service oriented and not as oriented as you were to the kind of foods you were serving and many other things. So how do you manage as a publicly traded company? What did you all do to kind of keep, you use the phrase North Star, how did you keep true to the North Star given all the pressures?
Well, number one is you perform. If you're a public company, you perform or you run into trouble. But remember, we went public in '93 at about 85 or 90 million in sales. We ended up, when we sold to Amazon, we were at about 16 billion in sales. So you perform. In other words, you can't use this as an excuse for not performing in the marketplace. Fortunately, we performed. So remember, the public markets are schizophrenic. What I learned in my time as being on Wall Street on behalf of Whole Foods and pitching our stock was that they're never satisfied. If you give them growth, they want earnings. If you give them earnings, they want growth. And so you quickly realize that, like, if you're going to chase that, you're going to chase your tail. And what you need to do is focus on building your business according to the North Star and the values that you set out for yourself. And so that's what we try to do, is really serve our stakeholders, all of them, including our shareholder stakeholder, and do the very just job we can. And our belief was that by doing that, we would produce the results that made shareholders happy. And that's, in fact, exactly what happened over the many years until the last year that we were public, when we ran into a little bit of trouble. But let me just point out that as we're doing this class today in 2020, and during this COVID crisis, you are seeing the example of some of that happen, where CEOs are stepping up and putting their team members first and talking about that and demonstrably getting behind that, whether it's extending benefits on furlough, whether it's keeping them on payroll, whether it's talking about their health and safety, whether it's any of the steps that you're seeing some of these major CEOs, led probably by my friend Mark Benioff with what's called the Benioff Promise. You are seeing an example of this becoming a more mainstream practice. And I will tell you, I believe firmly that companies that do not have their team members in this situation, when this passes, and it will pass, customers are going to remember how companies treated and thought about their team members, and it will not serve them well. Conversely, those that do a nice job that way, the loyalty they will earn, both with their team members and their customers, will certainly be remembered.
Okay, so that's a good answer. You take care of your team members and you take care of your customers, and then the shareholders will be happy, and then maybe there's less of a trade-off than many people think. I think that's a very good point. I also remember going to the annual meeting in 1998, I believe it was, when you held it in San Francisco, and some analyst asked John Mackey. He said basically, as you open stores, when the store first opened, it wasn't profitable. It took, of course, a little time to ramp up. And so the more stores you opened, the more quickly you opened them, the lower your earnings were in the short term. And John looked at him and he said, by the way, he said, if you don't like what we're doing, there are only so many locations where we can be profitable. So if you don't like what we're doing, you ought to sell the stock. So John was pretty clear that, he only wanted shareholders who believed in the vision and values of the organization.
Well, I think John in particular is, and I mean, he wasn't always the most diplomatic, as you evidence right there, and which is why I did most of the work on the street, just because he didn't really care for it. His view was Wall Street in general was just very short-sighted, and in fact, the average public equity hold in the U.S. today is something like 4 months. And the question is just how the heck can you build a quality company with a 4-month time frame? And the answer is you can't. So there is kind of a fundamental disconnect between short-term capitalism and the type of conscious capitalism that we were trying to practice. And I think John would get irritated. Last time I checked, grocery shopping is a voluntary choice, as well as your stock investments. You invest in what you want. You don't have to. If you don't like Whole Foods, don't invest in it. I mean, wouldn't say it that way, but sometimes John would. And, people also respected him for his directness.
No, I think that is exactly right. John had some very strong views. And how did you work with him about that? I'm thinking of two views in particular that were quite controversial. He was kind of a libertarian, so even though he loved his employees, he was not big in favor of labor unions. And of course, he's quite famous, I think, for his editorial in the Wall Street Journal around the time of Obamacare, coming out opposed to Obamacare. How did you guys work together to kind of balance each other out?
Yeah, well, you picked out two of the more prominent situations that occurred along the way, John. I mean, with respect to the first one, look, Whole Foods was a team member first company. And we said over and over again, if team members want to join unions, that's their choice. They chose not to. We did and remain a non-union company, but not because we were anti-unions. I mean, John's personal view is set aside here, but because we believed that we wanted to have a direct relationship with our team members, and we believed in taking care of them. So look, we were ahead in terms of benefits. We were ahead in terms of culture. We were ahead of a lot of ways where it made us a good place to work. And as you know, we were Fortune Company's best places to work 18 or 19 years in a row. We were on the list the first year and on every list thereafter. So folks chose to work there because they felt like they were participating in something greater, and it was less about unions. And as you know, in unions, it requires that you have to go through an intermediary, and we just didn't want to build that sort of a culture. We wanted to build a culture where we would talk directly and respectfully with one another, and if we had more time, there's a lot of mechanisms in the company's culture that were set up to support that. So with respect to so again, my answer always says, like, look, this is who we are. I'm not saying that's who everybody is, but our company is organized this way, and that's how we think about it. And our core value of team member happiness and excellence being our second most important stakeholder back that up. The second thing with respect to the healthcare, yes, I do remember that, of course. And John published a thing in the Wall Street Journal and then left for 5 weeks on a hike and left me there hanging. And the wheels did come off a bit, particularly with our team members who were very concerned. And so what I did is I got a hold on John. We're going to have to make it clear that this is your point of view as opposed to the company point of view, which we did. And then he took the responsibility for it. And second of all, I said to the world and to our team members, said, look, see, our Whole Foods have health insurance. We provide it for them. We pay for it. They have the latest and best benefits. So as a company, what we're doing is we are backing up, providing healthcare and health care benefits for our team members. So John's individual view over here about how markets work, but in practice we are. So I mean, like, I just tried to. His view didn't reflect the view of all the leadership of the company, nor did it reflect our actual practices of the company. So the best I could do was really just say, look, here's where we are. And that's how I tried to handle it. But look, like anyone that's got strong points of view, you learn. I learned so much from John. I think he learned from me, but we were a blend of those things as we tried to build company Whole Foods and take it forward.
Yep. And Bernadette has given me a little note that says to the students, send your questions through the chat as you come up from them, and we're going to try to ask you questions from the students as well.
Wonderful.
And one of the questions that the students have asked, and it's I think a very important question, is the merger with Amazon. And I don't know how much of this you want to talk about and what you're willing to say and what you're not willing to say. But Amazon, as you know, has not been necessarily known for its team-oriented culture. There's been a bunch of articles about its warehouses and a bunch of other stuff. What has changed in Whole Foods since the merger?
You certainly jumped right ahead, didn't you, to the marriage proposal? The question is, what has changed? There's so much to talk about in terms of the decision to sell Amazon, which was a very painful and difficult one to make in the summer of 2017. Look, on balance, the combination of the physical and the strengths of Whole Foods and the digital strengths of Amazon, our strengths in culture and people, their strengths in data and technology, has been a good fit overall for all the stakeholders. And in the end, I think in difficult times, which some of you may remember was the case for Whole Foods in 2017, with our stock down substantially and under pressure from the street and activist investors, we went looking for a partner who we felt could sustain Whole Foods values along into the future. So on balance, I think this has been a very good thing for all the stakeholders from the situation that we were in. How do I think it's changed? For the first part of time, really, Amazon left Whole Foods alone. And in this last during the COVID crisis happening right now, obviously they have tremendous strengths and scale and logistics and safety and protocols and procedures and so forth. So they have been really leaning in to help reset some of those things to make sure that we do the very best we can for all of our stakeholders. That I don't know specifically when they say what has changed, I think it's fair to say that it's not exactly the same company as it was, but nor is anything in life at some point. And we had an unbelievable run of close to 40 years before the transaction happened. And then I think, you have a situation where you need to evolve. We did not evolve fast enough on the data side and the digital side as fast as we needed to, and that was on us. So I think you have a company that is going through a process of change now, serving customers in new ways. But the core of the idea that the quality of food matters, the quality standards of Whole Foods, and all the passion around that still lives inside the company, and still lives in the product mix and the support of producers that are the products that you're able to purchase there. So I'm not going to say it's exactly the same. Does it feel exactly the same as it did in the way of building it on the way up? No, it's owned by Amazon 100% now. And so it is a different chapter for the company. But I'm grateful that so far the quality standards for the company have not changed. They're still there, and they represent the highest standard of care in the supermarket industry.
Yeah. One of the things that John Mackey said right after the merger, and I think you said this also when we talked the other day, was that part of the evolution. And one of the things that he talked about is to Whole Foods, that there was this nickname, which was not very popular, was called Whole Paycheck. And that, I think one of the first things that Amazon did is they cut some prices in the stores. Isn't that correct?
Well, yeah, there's a lot. We should talk about that Whole Paycheck thing, because there's a lot to say about that. Because, but let me go to your question. Is the decision? Whole Foods had already been working on that as part of our sort of response to where the fact is in the 2016 in particular and 17, the marketplace started to catch up to Whole Foods. In other words, after all these years, there was a lot more stores offering a lot of the products that we had been offering. And so the marketplace began to do what it does, what markets do. They competitively evolve, and customers had more choices of where they could buy some of these products. And so as a result, we were looking at all sorts of things: better marketing, better communication of our differences, as well as price. And so, but Amazon, we basically, since the merger, done basically 3 tranches of price reductions. selective, strategic, not across the board, but the first basket, the second basket, the third basket, to where, yes, Amazon was willing to invest the gross margin and make less money to be able to do that. And so, yes, they have successfully done that, resulting, as you know, in the closure of our 365 banner because the gap kind of narrowed. But if you will, Jeffrey, let me just take on the larger question you're asking about the nickname that I shall not repeat because I've heard it too many times. So, look, the purpose of Whole Foods, I used to get questioned all the time about our price points, and I would say to you this: look, all food is not created equal. The quality of food varies depending on how you produce it. If you're going to raise a chicken for 7 or 8 weeks to get full flavor, it's not going to cost the same as a chicken that you raise in 3.5 weeks and just jump it into the market. And so now for some people, they can only afford what they can afford, and that's okay. There's no judgment there. But our role in the marketplace at Whole Foods was not to lower our quality standards, but was to stand up for quality in the marketplace and to raise the level of quality in the marketplace. That meant we were not for all people. We were not trying to be Walmart, all things to all people. We were trying to be the quality standard bearer in the marketplace. That was our role. That meant not everybody would or want to shop there, and that's fine. That was okay. We still had 8 or 9 million customers a week going through our store. That's a lot of traffic. That's a lot of people who said, I like what you're doing, keep going. And so I would always get challenged on CNBC about what about your prices? What about trying to say, look, we are not going to participate in a new race to the bottom in food. We are going to try to participate in a race to a new top in the quality of food. And if I sit back now after all these years, I would say the one thing I'm most proud about what the team and we all together accomplished is I think that the marketplace today now understands that there is a difference in the quality of food, and there's a direct connection between that and your health and well-being. That was not the case 30, 35 years ago. That is the case today. And I would say the supermarket industry ended up moving more our direction than the other way around. So, try not to get defensive, but when somebody says that, it demonstrates. I would always say to them, well, on which item and on what price? And let's talk about it, and let's see if there's a difference or not. On like items, exact like items, there is no reason to be higher priced. They're right about that. But on something that's fresh food, that's grown differently, produced differently, with more care, that there is a reason for it to be different, and that's just a choice that the customers have to make.
And by the way, the other difference that I experienced when I used to shop at Whole Foods, because it used to be closer to me than it is today, is the difference in service. So the amazing that you could go in Whole Foods and people were out in the store and you could ask them where stuff is and you could ask them about the merchandise and they could give you an answer. I go to Safeway, which is close to me, and half the people don't know where anything is. And I remember Peter Roy in the famous In Search of Excellence video made by Tom Peters many years ago. I think Peter was a senior executive at that time, said that the quality of service in the grocery industry was awful. And the quality of service in Whole Foods. So it's not just the food where you had a differentiation. It was also a very big difference in the quality of the service that you were providing to the customers.
Yeah, well, remember our business model was very different than the super business model. The supermarket business model is somewhere around 10 or 12% labor, and Whole Foods more 17, 18, 19%. We invested in the team members. And you mentioned the cultural at the outset here. And again, part of that was the team members feeling like they were part of it. And part of what you felt when you crossed the threshold was their ownership of the mission of the company. So it was not only did we invest more, our business model was different in terms of putting more team members on the floor and in the customer experience, but it was also, I think, the general culture, which made them want to talk with you and say, hey, what about this piece of cheese? Or I think you got to try this piece of fish or whatever it is. So the supermarkets at that time really were not, their business models were not set up that way.
Yeah, no. And Whole Foods, I believe this is true, also had a higher percentage of people with college degrees working actually in the store than the typical supermarket.
Well, actually, the bigger statistic, Jeffrey, would be the full-time part-time ratio. Our full-time part-time ratio at that time was around 90-10, 90 full-time, 10 part-time. I think now it's around 75-25. And the reason is because your part-timers, they don't earn as much typically, and they don't get the benefits that the full-timers do. But when I went to supermarket school one year at Purdue University, and I was taught that the supermarket industry, the right numbers were something like 30-70. You should run 30 full-time, 70 part-time. So part of what you had going on in the supermarket industry was a flip-flop business model than what we were practicing in Whole Foods. And our belief was that the full-time team members would be more enrolled in the mission and the culture, hopefully delivering a better experience. So we were at odds with the supermarket industry on the business model to this day, actually.
Yep. So Peter Grogan has asked a question, which I think is an interesting one, and one that I think touches on what you're currently doing. How do you think COVID will change the future of food and food retailing, and maybe even the agriculture industry?
Yeah, well, it's already changing it in so many fundamental ways, and it's exposed so many fundamental things. But it's a little early to say exactly what ends up happening 6 months or 12 months from now. But we can say the following things. Number one, it's become clear that if you that a lot of foods, in 2019, half of the food goes to restaurants, half of it goes to grocers, and the restaurant piece has been completely devastated, and probably 30 to 50% of them don't make it through this. So what you've seen is a tremendous spike in sales to the grocery channel. What that's revealed is the fact that our food production system produces a lot of food for both, and the narrow the twain shall meet. In other words, a lot of stuff packed out for the food service doesn't just flip over to retail. Hence, you have farmers dumping milk, you have farmers dumping chickens, you have farmers plowing under onions, because the stuff that was developed for restaurants doesn't really translate over into a consumer pack, which is demonstrated we don't have the agility in our food system that we thought we did. It's something we're going to have to work on. We probably have a crisis merging here, probably 40 million people who need help at the food bank. We're completely overwhelming our food banks. They've run out of supplies. We have a real crisis in the next 4 to 6 weeks that we're going to have to think about. How are we going to support those people who need food that just don't have it? We have the retail experience itself. Obviously, at Whole Foods now, you got to wear a mask. So we're going to have social distancing. We're going to have a reduction in some of the fresh food that customers don't trust because they don't want something that they can sneeze on. You're going to have all these sorts of changes in restaurants if they do open, where less tables. But so some of these things are the new normal in terms of how you're going to experience a retail thing. And you have a tremendous accelerant in the adoption of technology and online. So in grocery, you're going to go from 3 to sort of 10% penetration on delivery. You're seeing this with the CEOs of Tractor Supply, Rite Aid. All of them been out there publicly talking about how customers are adopting online and digital much faster as a result of this crisis. So what exactly, and you're seeing right now in the Nielsen numbers, dry beans, pasta, things like this are up 60, 70, 80% as customers try to figure out how do they prepare their home for food, and how, with something they can't 100% trust. And I also think that there's generally kind of a fear out there right now about the virus that we just haven't put to bed, because we don't have enough science to sort of say, how does this all work out? And then, of course, we've got the experiment, which is federalism, with some states opening now and some say they won't open until they don't know when. So we just have a lot of open-ended questions here that are going to, but I think we see some of the basic trends are going to have accelerated here. The online penetration, the food safety, the social distancing, these things are going to continue as far as we can tell for the future.
So you do believe that delivery is going to become a bigger part of the grocery industry?
Already has. I mean, it's already out of control. I mean, I can tell you Whole Foods and Amazon right now cannot keep up with they're beyond and being able to fulfill. We've taken some stores and taken them what we call dark, which means they're only existing to fill orders. Same for Instacart. These others are all struggling to keep up with the demand, which just is more than they're able to do. So you have a hard time. If you want to try to get a slot for delivery, you may be out a week, you may be out 4 days. The system is not caught up. The real problem in the food system here is not so much the growing of the food, we're just unable to get it to the store. The throughput is probably running at 200% over capacity, and they just simply can't run enough stuff through. The pipe's not big enough right now to be able to get the things supplied. And so as a result, you're seeing reduce the SKU, reduce the number of units, reduce the selection a little bit, just to try to get the system back up and running again.
That's interesting. I like that. And you think in terms of how the business model, is this going to be, I mean, one of the things we've already talked about is I mean, Whole Foods has better lighting and better smell and better layout than the typical supermarket. Many of your competitive advantages, I think, were based in part on the actual in-store experience, the higher level of service that we've talked about. How does that business play out in a delivery context? I mean, I can't go in. I mean, Whole Foods did such a fabulous job with lighting compared, for instance, to my local Safeway, which doesn't seem to understand the concept of lighting. Such a beautiful display of the food, such a beautiful display of the bread, all of the things that you did to make the high quality food very enticing to the consumer. How does that play out in a delivery scenario?
Well, let's remember that we're human beings, and in the end, we're still going to want community. I just put a post on my LinkedIn account where the CNN had written articles saying maybe it's time to close grocery stores to customers. And I put back on that saying, I think the grocers will continue to innovate to create ways for that to happen, because that's what human beings clamor for, community, and there's limits to what you can do on a digital platform. But, I think that you have to do the work to translate your proposition, your value proposition on the digital platforms. Now, a lot of the students are digital. Those are the platforms they travel on, and they're probably very comfortable maneuvering and moving around. For some of our generation, we've got to kind of learn a new language and a new agility to do that. But all brands, there's many brands now that have gone native, just built themselves up to 5, 10, 15 million online only, and they know how to do it very well. Every other company is going to have to learn some of that skill set to be able to prosper and survive. So I would say Whole Foods, because of the technical prowess of Amazon, the data prowess of Amazon, is going to be at a certain level right away. And I think then the being able to communicate those things around the product attributes, the experience, that'll have to develop over time as they figure out how to put some of those things in the digital format. But remember, physical stores are not going to go away. So
I hope not. So another question has just come in, which I think is an important one. It's interesting, obviously, grocery is considered to be, for obvious reasons, an essential service, which means that you have people delivering food to the grocery stores, you have people working in the grocery stores, albeit with social distancing and with controlling the number of customers who get it at any one time. But the question has come in is, how do you think Whole Foods and Amazon are balancing the well-being of employees during this COVID crisis with their role as an essential service provider? So you, on the one hand, have to be open, on the other hand, and you need to take care of your employees. Talk some about how you see that playing out.
yeah, well, I'm not as familiar with the situation in the Amazon warehouses as I am in the Whole Foods Market stores, where I'm pretty darn plugged in. And look, I may be biased, but I think they have led the way, first by putting the plexiglass first one's to put the plexiglass screens up, the second one to get out there in terms of the rapid cleanings, the protocols. If somebody did get sick, closing the store right away, getting it re-cleaned, reopening, providing team members the safe out if they need to take 2 weeks off. All that stuff was first in the nation in terms of getting all those things in place. And then if you go to the stores now, the hours for seniors, the metering in the front door, the guidance in the store around how to keep the 6 feet, the spreading out of products so that it's not as opportunity to be congested, all those things. And right now they're testing infrared cameras for team members to check in before they punch in to make sure that their temperature is good. I don't think there's any company that's been more progressive in terms of thinking ahead. As the science reveals this stuff, remember, we're driving on this bridge as we build it. We all don't know the answers to these questions about what this is, where it goes, we're having the guidance changes daily. So I think I'm very proud of Jason and the team there and what they've done to really stay on top of it. And they have worked so hard, relentlessly, 24/7, 7 days a week, working to try to stay on top of what's happening and keep making adjustments to keep the health and safety of the team members front and foremost, and the health and safety of customers.
Yeah, and you did say something.
I'm biased, Jeffrey.
That's good. You ought to be biased. And one of the things that I think you said as part of your answer, which I want to highlight, is that you are one of the companies that do provide paid sick leave for people.
That's right. Of course, yeah. I mean, the idea is if you're not feeling well, or if you need to take off, then you've got the 14 days and you're paid for that. I mean, a lot of companies have adopted that, but I think it's like, why give somebody, if folks are concerned about losing their paycheck or losing hours, take that off the table and you just say the health thing is, and certainly some people will take advantage of that and misuse it, but on whole, I think team members are honorable and it gets used and it does provide a little bit of a relief pressure. And by the way, the opposite is true, is that many of our team members want to be there now. They understand the essential role that they're playing. They understand the service they're providing the community. They understand how the customers need what we do. And, you know, I will tell you, one of my greatest learnings as a leader is the belief in the incredible each and every individual. And I've learned that over and over again. And you see that with how heroic our team members they are in the service of our customers and each other. Truly amazing and truly inspiring.
I have a question that's coming from Emily Carroll, which is, I think, a fabulous question. She points out that you're an advisor and an investor to many small food-related businesses. Could you share some thoughts on how you're helping these small businesses navigate what is clearly a very difficult environment?
Yeah, I think just thank you for that question. I think I guess I am what you call a gray beard at this point, in that I'm I'm older. I think it's the experiences that I've had. I went through the Great Recession as CEO. I understand that business is not a straight line, and I think what CEOs are having to make very difficult decisions now around and make quick decisions. And I think leaning on someone who's had experience, who can help guide them through that decision making, as well as thinking strategically about how they may have to pivot with their business model, how they may have to think 3 months, 6 months from now. Having had the perspective of 40 years in business, I think my greatest role is really around someone to talk to confidentially, someone to get some feedback around decisions that need to be made or decisions that could wait, around the need to think ahead and how do you put a part of yourself in the future where you need to be thinking about what the world's going to look like after this down. And so primarily my role, I would say, has been in those sorts of areas. And conversely for me, not actually running a company right now, to be that close to the action without actually being the CEO is very rewarding for me to be in those conversations that matter.
Peter Grogan has another question, which is, I mean, COVID, as you've said, and I think many people believe, has changed things. It's changed the percentage probably permanently of the food that's going to come through delivery. It's changed many aspects. What kind of investing opportunities do you think it's creating in the food space?
Massive and monstrous, and will more. I mean, simply because there's going to be a lot of capital destruction here in the next 6 months. What I mean by that is there's going to be many businesses that don't make it. There's many businesses even large businesses out there borrowing money at ridiculous interest rates to shore up their liquidity. There's going to be many businesses out there who have invested in things that are going to be worth 10 and 20 cents on the dollar. So the opportunities are going to be, if you're a strong company, you have a strong balance sheet, and you have good liquidity. In the next 6 months, there's going to be a lot of opportunities for M&A, chances for you to find companies that can do what we talked about earlier, strengthen your company, combine forces. And so, I think that's one of the things that's going to come out here. It's unfortunate, but it is happening in capitalism. There's no guarantees when you start a business you're going to be successful. So those that have chosen to be more careful and have the greater liquidity versus those that have continued to lose money and be funded with venture money, there's going to be a reckoning here. There's going to be a reckoning here, and some will be able to take advantage. You're already seeing that in the landscape today, where you've got winners and losers. You can see who's winning now with the companies that have the big scale and have the big, investments in technology. The Amazon, Target, the Walmart of the world, they're winning. They're just flat out winning. So we're just going to see this landscape shift, and the restaurant thing will be completely altered. The food businesses, a whole new generation of food businesses that are going direct to consumer or working digitally will appear. A lot of physical stores, particularly retail. We're at about 23 square feet of retail per capita in the U.S. versus sort of 10 or 12 anywhere else and there's going to be a rationalization of real estate and retailing that's going to happen. So there's going to be a lot of destruction in the economy as we have known it, and like always, a rebirth, just in new forms. That's capitalism.
So one of the concerns out of that, if I can ask a follow-up question, one of the concerns is around the issue of consolidation and antitrust. Certainly in some industries, like in the airline industry, customer service has probably suffered as we've permitted a lot of consolidation. Many people believe that's also true in the cell phone industry with the enormous consolidation. So how do we balance as a society the issue of what you just described, the consolidation and the emergence of maybe Amazon as the only retailer left, versus this idea of, having a competitive environment and having choice?
Well, I do think there's a thesis out there that says that, Amazon keeps growing and successful, but there's still a thesis out there that says people still want options. Instacart would be a good example of that. In the Bay Area where you all are, there's both Good Eggs based in Oakland, which is now servicing fresh food to your house. And there's a little company called Farmstead out of San Francisco, which does so on a limited SKU basis. So there's already choices if people choose to take them. I mean, Amazon does such a good job on the convenience side of things that they've set a whole new bar for what it means to serve your customer. And other companies are going to have to step up to the plate and be able to reach those same levels of service that customers have come to expect. If you go back and study your American history, there's many times where we've gone through this wave of consolidation, and then there's been, like with Teddy Roosevelt, trust busting, I think the Justice Department has a function. We actually ran into that ourselves in 2007 when we tried to buy Wild Oats, and they tried to say it was over consolidation, which they were idiots about that, but that's a whole other story. So I think you see the waves of history in this as you find the consolidation, then you find forces joining. Now you're seeing that happen for the large tech companies right now, where the government's kind of woken up around data privacy, around transparency and digital platforms, and they're moving in to create some competition and create a breakup, and that's happening kind of worldwide right now. That same thing will happen as customers begin to say that they're experiencing. The difference with Amazon is it's become deflationary, not inflationary. Typically, when you have competitive consolidation, you have a raising of prices and a lowering of choices. What you have with Amazon is a lowering of prices and a raising of choices. So I'm not sure there's a corollary in history up to this point, but we have seen with the tech industry that crossing the line with the use of our data, the lack of disclosure, and the amount of control, and you're starting to see them face the music for that right now, and that may be a proxy for what comes in any other industry.
Yeah. And the final question comes from Danny Gold, which is around the issue of food delivery. Good Eggs, I think, has had some financial challenges. There's been a whole issue about whether or not people in Instacart and many of these other services, Uber Eats and the DoorDash and whatever, and whether or not these are really economically viable businesses. Do you think that COVID-19 will push enough business towards delivery that it can help solve some of the economic challenges that a lot of these delivery companies have faced?
Well, I think the standalone food delivery business model doesn't really work economically. I think it's been propped up by a lot of venture money, whether it's DoorDash. Shipt got bought by Target, so it's got the economics of Target, but these individual ones, whether it's Grubhub, Uber Eats, they're all failed business models, and they're just not telling the truth. They're not making any money. All of them were a play to become market leaders and then hopefully leverage that into the other parts of their thing. But Good Eggs was invested by Bill Gurley from Benchmark, one of the best venture capitalists in the world. So they've got some serious oomph behind them, and they've doubled their volumes during these times, got a new facility. So it's too early to say. Instacart is raising money at $13 billion valuation right now, in part because they're the alternative to Amazon, and folks want an alternative to Amazon. So Purv is a pretty smart business guy. I did that deal with him for Whole Foods many years ago when they were little, and he's a pretty sharp guy. And, I think they're seeing tremendous growth right now as people want that sort of choice out there. Whether their business model works over the long term, they're not having that issue right now because I think they have achieved cash flow break even in a couple of markets. But What is interesting is the new business models that are emerging, which are kind of, if you look at Domino's, you remember Domino's focused on delivery, and they own their own, they're kind of vertical on this. And we've seen new businesses that are set up specifically for takeout and delivery and are controlling the vertical of delivery. And their economics actually work because they're ring fencing to control the delivery time, et cetera, et cetera. And so what we're going to see is new business models that are set up that actually take into account the actual cost to do last mile. But many of these ones that are out there now are flawed, and when the money runs out, the dance will be over.
Let me thank our guest and Professor Pfeffer for an incredibly interesting, informative conversation. And with that, thank you so much. I hope you enjoyed the session and have a good rest of your day.